Okay. Hey, everybody. We have Tatiana with us for the Mortgage Minute for the week.
Missed you last week.
Hello, how are you guys?
We're good,
Very
good. So what's going on with the interest rates? It seems like they were coming down quite consistently, but are they still coming down? Are they starting to trend up? What's going on?
Yeah, so the interest rates actually increased due to the year-over-year core consumer price index. Right here you can see that now rate is 7.09%. I know we missed last week. It was lower, and week before it was 6.609, I believe.
Yeah.
So. And the core consumer price index, short for core CPI, measures the changes in the price of goods and services, excluding food and energy coming. So it came in at 3.9 versus 3.7. And this is an expected 3.7. So that's an indication that prices, food, clothing, shelter, goods, and services that were paid by consumers are still higher than expected. So as a result, Fed will likely delay the beginning of the rate decrease.
Okay.
But with today's retail sales numbers that came in significantly lower than expected, a slight contradiction to what happened yesterday. So that's a sign that consumers are feeling prices increases, which could signal the Fed to consider lowering the rate soon. So as you can see, it's not,
It's a balancing act, yeah.
Yeah.
right, yeah, it's not white or black. It's really hard to predict what's gonna happen. We can just kind of like listen and see the data and listen for the comments and do base predictions on those comments and whatever the data comes in. But in the meantime, the immediate reaction of the rates was to go up.
And this is a good example of, when we talk about not trying to time the market. We have so many people kind of sitting on the sideline right now waiting for the rates to continue coming down. Well, now they're up a little bit, and if they had locked rates last week, it'd be a completely different scenario than it is this week. So it's just a matter of like making a decision, just doing the best you can, and then going from there. Because we're back up over 7.
Yeah. And always knowing that you can refinance.
Yep.
Right? If the rates drop. That's always something to keep in mind.
Yep. Okay, so in response to the interest rates, we've had a lot of VA assumption loans that have been coming down the pipe. And I've been hearing that they're taking a lot longer than normal to happen. So how does that work? How does someone assume a VA loan? What are the rules behind it? And what's the process for that whole thing?
Yeah, so the assumption itself, what does it mean? It means that the buyer could take over the current mortgage that sellers have, right?
And keeping that interest rate and everything?
And exactly, so keeping the same terms, they just basically taken over the existing mortgage and releasing sellers from the liability, taken over, but they have to qualify for it. So the process is that they have to contact the bank that is holding the current mortgage. They would do the application to make sure that buyers qualify to take over. So there's some potential benefits of that, right? So we have significant monthly savings. If right now interest rates 7% on VA, they're lower. It's government programs, they're in mid 6%. Versus the sellers probably have 2-3%. Even if it's 4, it's still a lot of savings for the potential buyers, and the costs and fees are lower. VA funding fee would be only 0.5% of the loan amount versus typically, it's 2.3% or even 3.5%, depending on, whether it's the first time a user of a loan or not. So potential challenges with that is, just like you mentioned, the process could take longer. Actually, this is last bullet point. Let me start the first one. Cashing out equity. What do I mean by this? Is the seller, of course, when they sell the house and they give in that loan to be, I assume they still want to get their cash,
Right.
their equity in the house, right? So let's say the house is $1 million. We just have easy numbers, and the loan amount is 700,000. They want the 300,000. They want to
Right.
take money out. So what it means that when buyer assumes the $700,000 loan, they have to come up with 300,000 difference.
Okay.
So
And
they can't finance that.
correct, on VA loan, you have to come up with cash. And some other loans, like FHA, you might be able to get secondary financing. Some conventional products also are assumable, like
Okay.
adjustable rate mortgage products.
Mhm.
So you might get a second financing, but with VA, you cannot do that. So you have to come up with money. So if you have money, you can do that. That's fine.
Right.
And it's good idea. The second potential challenge is impact on the VA entitlement. That's challenge more to the seller than to the buyer.
Okay.
If the buyer is not a VA eligible buyer, is not military, active duty, or veterans, they still can do the assumption, they can take over the loan. However, the seller will not get release of their entitlement. It means that that entitlement is going to be held up with this property until the buyer refinances, which is probably not going to happen if the rate is
Right.
2%, right?
Yeah.
Or if they sell the house. Only after that, that entitlement gets released. And what does it mean to the seller? It means that they potentially might not be able to get another VA loan, or they would have to put money down. It's actually a myth that you can have only one VA loan. You can have multiple VA loans, but it all depends on how much entitlement was used up and how much entitlement you need to use for the new loan. And that's a formula that we calculate, we use to determine, do they need to put money down or not on the new VA loan. And
so is it possible? So if they didn't use a whole lot of their entitlement on the one that is being assumed by a non-qualified buyer, is it there a realm of possibility that they might be able to get their next house with a zero down?
and it's possible, depends on how much eligibility or entitlement was used on current home and how much they need on the new home. But also another potential issue that I could think of is, what if the buyer is gonna default on the loan?
Right.
Yeah.
So that's gonna completely mess up their entitlement, because it's gonna be on the record that they defaulted on VA loan. And
Oh,
even
wow.
though
Okay.
it's not the seller who defaulted, it's a new buyer, but it's their entitlement.
So it
Okay.
defaulted on the entitlement, even though it was somebody else's credit. Now, if a qualified VA buyer assumed a loan and then they defaulted, then it would go against that buyer's entitlement, right? They're not risking the seller's entitlement anymore at that point.
Exactly, because if it's a VA buyer who is assuming the loan, the entitlement is gonna get transferred to their entitlement and will release the sellers.
So that would be the
Okay.
best case scenario, is another VA buyer, qualified buyer coming in and assuming a VA loan. Okay.
That's correct. That's
And then the lengthy process, how long would that process take on a good file, a straightforward file?
So the full disclaimer, I don't do assumptions,
Okay.
because assumptions are done by the bank that holds the current loan, right?
Right.
So I'm dealing with new transactions. I'm not dealing with already existing mortgages.
Yeah,
Right.
What I heard, because I'm in the industry, right, and we talk and share the experiences, I've heard that it could be 60 days process. However, I think it all depends on the bank and how bank is familiar and efficiently working with
Yeah.
the assumptions. I compare it, I think we spoke about it before, right? So I compare it kind of like when we had times with foreclosures or short sales, when, in theory it exists, but nobody knew how to deal
Yeah.
with that.
Yeah.
So the same thing is here. Assumptions were here forever, but this is pretty much the first time it actually, being used. So the banks don't really have a system and process or good system and process. So it's a learning curve for them. So maybe now it's faster than before, or it
Yeah.
all depends on the bank. Maybe some banks that already dealt with a bunch of them, they know how to do it faster.
Yeah.
And for some, it's a still new thing, and it
Okay.
will take longer. Short answer to the question is it's gonna all depend on the bank.
Yeah.
And
Yeah,
you
right.
need to talk to them and see how long it's gonna take.
Okay. Okay.
Right.
Yeah.
All right, well,
That was really good information.
this is helpful. Yeah, I think this will help a lot of people. So from a seller's perspective, just if they just need to understand right now that it could take a little bit longer for settlement to occur. It's a benefit. It obviously is going to be enticing to people to be able to assume that low interest rate loan, but they just have to understand that they're going to be on the settlement timetable is going to be pushed back.
Right.
Yeah. Okay.
Yeah.
All right. All right. Oh, I have one more little quick question. So let's say in that scenario that you said where the VA, the loan balance was 700,000 and the house was worth $1 million. Is the appraisal an issue? Does it only have to appraise for the 700,000, or is there some kind of a debt to income ratio that transfers into the new assumptive situation?
So I think that I'm not 100% sure on that, because in general, VA loans, they could be 100% loans, right? So
Right.
I think as long as the value comes in at 700,000,
Okay.
we are good. And I think it's for buyers' benefit to do the appraisal
Yeah.
to see how much actually house worth. Do we need to give them 300,000
Right.
Mhm.
or not?
Okay.
Okay.
Interesting.
Yeah.
Okay.
Good.
Very good. Do you have any questions?
No.
Okay. Awesome. All right. Do you have any questions for us, or are you all good?
No, I'm good. So I'll see you next week.
Yeah.
I'm so excited about that.